When it comes to investment, repeating history is not such a bad thing. No investor hates the thought of making more money, but that doesn't mean you need to invent new ways to do it. While inflation concerns increase and the hike of interest rates may be scary, you can decide to invest more safely. With dividend stocks experiencing a dip, this may be the best time to secure your future gains. Dividend investing is an excellent method to diversify your portfolio without committing all of your funds to a single investment. It allows investors to get a return while also generating additional income over time while getting a return as an investor. This saves you from the worry of dealing with economic crashes and underperforming stocks. The best places to invest your money are places that have shown consistency. It's also crucial to avoid treating dividend stocks as overly defensive investments. Only after several years of exceptional performance can a considerable portion of earnings be set aside for distribution to investors. If the core business isn't performing well, the corporation can't afford to give profits away. In this video, we will show you 7 high-quality dividend stocks that will be great for you this year. 1. Automatic Data Processing, NASDAQ ADP. With automatic data processing, small businesses gain access to premium accounting and human resource services. Automatic has been in business since 1949, focusing on data processing. If your company needs it, they may handle payroll and other HR responsibilities such as benefits management and even productivity tracking. ADP is a corporation that accomplishes more than most others in their field. They serve over 860,000 customers in 140 countries and perform common operations for all types of businesses, making them the industry leader. Even though the work and finance industry is constantly changing, ADP retains a considerable competitive edge over its competitors thanks to its strong brand and high switching costs. It might not grow like Tesla did, but the company's operating metrics are not slipping. ADP stock has achieved 45 years of consistent dividend growth, which is proof of their reliability and dedication. The payout ratio of 65.82% for ADP may appear to be excessive, especially given the company's maturity and stability. It did, however, generate $2.6 billion in free cash flow in the previous year. As a result, the company's position as a dividend aristocrat is safe. 2. Intel, NASDAQ INTC. This company has had a rocky journey for sure. Intel, NASDAQ INTC, was the chip king a decade ago, with AMD, NASDAQ AMD, and NVIDIA, NASDAQ NVDA, playing lesser roles. But now things appear to be changing. The two younger corporations appear to be preparing to succeed their old leader. NVIDIA in particular has made significant progress. Intel's problem is a lack of innovation that has almost made it obsolete in the industry. Why would we still advise you to buy stocks here? Intel has a new processor line called the Alder Lake 12th generation core chips, which have started to eat away from AMD high-end processors. They are also expecting new releases in the next 2 years, including what they claim is the fastest mobile chip ever made. This gives hope of a comeback that will have them regaining lost time. Despite their problems, INTC stockholders were paid 30% of their profits in dividends over the past year. This great payout ratio ensures that investors get their money back. It does, however, have room to expand in the future. 3. CocaCola, NYSE KO. CocaCola has recently struggled to compete with the growing popularity of the low-carb diet. Consumers are now choosing healthy drinks like Soylent or sparkling waters over their typical sugary versions, and the corporation has lost market share. However, the beverage behemoth understands the need to modernize and stay up with the trends. They have now started to offer sparkling water, teas, and milk. They've also introduced new zero-sugar versions of popular soda brands like Sprite, which grew 25% faster than the regular non-zero sugars version in the last quarter. Coca-Cola purchased sports beverage business Body Armor for $5.6 billion in a move that will have a huge impact on the athletic goods industry. This offers them immediate exposure in this specialized market, and we should pay attention. Powerade, a Coca-Cola product, has long been a distant rival to PepsiCo's, NASDAQ's PEP, market-leading Gatorade. It accounts for 23% of all sports beverages sold, even when paired with the Body Armor product range. If you're looking for a corporation with a lot of experience, look no further. With a 59-year history, KO's stock dividend is certainly one of the longest-tenured dividend aristocrats. 4. Chevron, NYSE CVX. Chevron is one of America's most profitable oil businesses. In terms of profit margins, this huge corporation and its competitors aren't even close. Chevron has always been able to produce healthy profits with little risk by taking advantage of lower fuel prices than other energy companies. Chevron is one of the COVID-19 period's few success stories. In a stunning all-stock deal, the business bought Noble Energy for $100 billion. Despite the pandemic, the corporation continued to pay a healthy dividend. In the last 2 quarters, they topped by an average of 22%. This company appears to be doing well, and it appears that the future holds more growth for investors who invest now rather than later. For example, the company earned $6 billion in the third quarter, compared to a loss of $207 million the year before, an indication that things are improving. Chevron has been repurchasing stock and paying down debt at a strong pace, which has surprised experts. The corporation is expected to continue this approach in future quarters, though no plans have been published. With $6.7 billion in free cash flow, this corporation had its best year ever. As a result, dividends on CHV stock are safe. 5. IBM, NYSE IBM. For quite some time, IBM has been on a downward trend. It's no surprise that Wall Street isn't overly enthusiastic about this company. Its stock has dropped 14.6% in the last 5 years. IBM paid $34 billion for Red Hat in 2019. This purchase strengthened its operations, improving its future potential for success in open-source software development. Simultaneously, the corporation is eliminating some of its old processes that are no longer necessary, such as the spin-off of Kyndryl, a legacy IT infrastructure services company, NYSE KD. In the third quarter, cloud earnings increased by 14% year over year. It will be some time before the new figures are released, but analysts generally expect them to start heading in the right direction again once they release some post-separation data. Consider investing in IBM stock to get some high profit. 6. Verizon Communications, NYSE VZ. Verizon is attempting to enter the communications and media industries. They've been making moves in this direction for quite some time. Still, it appears that they are finally ready, as their wireless service has also become commodity level, with little variation between carriers or plans. The United States and other developed countries throughout the world are already overburdened. Verizon has been broadening its wireless business by acquiring AOL and Yahoo in order to capitalize on the rapid use of online advertising, particularly video advertising. These endeavors, however, did not pan out. Verizon sees the 5G revolution as a huge opportunity. It not only allows them to modernize their consumer gadgets and other smart technology, but it also allows them to shift to enterprise customers with fleet management software, which should increase income even further. In just 1 year, Verizon has added 14,000 new 5G ultra-wideband cell sites. The markets, on the other hand, are harsh. The stock price of VZ has dropped 7.8% in the last year. A 4.7% dividend yield isn't enough to persuade investors to give this stock a chance. That might not matter because this being a 5G effort makes a forward price-to-earnings ratio of 10.1 appears to be quite appealing. 7. McDonald's, NYSE MCD. McDonald's is one of the top dividend growth stocks. In 1955, Ray Kroc founded the first of his chain of fast food restaurants. It has subsequently developed into an international conglomerate with burgers, real estate, and franchises worth billions of dollars outside of the United States. McDonald's may not be a growth firm, but it has demonstrated a remarkable capacity to weather economic downturns. During the Great Recession of 2008 to 2009, the fast food behemoth increased earnings per share and has increased dividends every year since 1976. Since its inception, MCD stock has paid out dividends, and it is now one of the most dividend-friendly firms in the United States. It takes a strong balance sheet not only for well-established companies like this legendary fast food business, which has $6.7 billion in cash on hand. It is also necessary for maintaining sustainable payout ratios. Thank you for watching this video. If you liked it, hit the button and subscribe for more.